Let's go ahead and get started recording these transactions. You'll see that I will be applying some of the hints and some of the rules of thumb that you saw listed in the outline material that came along with the material in this unit. One of the hints is to, first of all, as you read a transaction, ask yourself if cash was involved and make sure you get the cash part recorded correctly in the transaction. That makes everything else a little bit easier. Here we see that Sample Daycare provided $50,000 worth of daycare services. Again, this is throughout their year. $6,000 was received as the services were done, and the rest of that was earned on account. So we know that cash will go up by $6,000. Record this transaction yourself, pause, and then come back and see if we do the same thing. Remember that generally accepted accounting principles require us to use the accrual method of accounting. In the accrual method of accounting, we need to pay attention to the correct timing of revenue. We record revenue when we provide the goods or services. It does not matter when we collect the cash. So, our question here is, how much of these daycare services were provided during this accounting period, which is year 3? Well, they provided $50,000 worth of services. They got paid $6,000, and the other $44,000 is on account. Remember our basic definition of revenue. Revenue is the inflow of assets in exchange for providing goods and services. Sample Daycare got 2 different assets. They received $6,000 of cash, and they received a promise from the customers that they would pay up the other $44,000 later. I'll put this in the spreadsheet in a few minutes, but here, so that you can see it more easily all in one place, is this first transaction. Cash and accounts receivable are both assets. They would increase by a total of $50,000, and to balance this transaction out, we record $50,000 worth of revenue. In this simplified approach, we're putting all of our revenue directly into the retained earnings account instead of putting the revenue in a separate temporary account that would then get transferred back to retained earnings in the closing process. And then off to the side here, to make sure we report this correctly on the income statement, you would add the notation daycare revenue. Let's go ahead and put it in the spreadsheet. I'm showing my increase to cash, my increase to accounts receivable, and on the other side of the equation, an increase to retained earnings with the detail, and I should probably be a little more clear here. This would be daycare revenue. Transaction 2 is one of those entries where we want to record this as if we're actually recording it on April 1st of year 3. So on April 1st, the company borrows $10,000 from the bank. That should be a simple transaction where you will increase cash and increase a liability account. In this case, I've provided choices of titles for you. The best choice in this case, because the problem indicates it's a note. Note payables are generally just more formal than accounts payable. Notes payable generally have an underlying document, due date, interest rate, that kind of thing. We're going to increase note payable by $10,000. We've increased our liabilities, and the other side, of course, is an increase to cash. We've increased the left hand and the right hand side of the equation once again by the same amount. Transaction 3, the firm pays $23,000 for the current year's wages. Was cash involved? Yes, in this case, cash will be decreased. We have a cost here. The question you generally want to ask yourself when a firm incurs a cost is, was that cost to get an asset, or did we incur an expense? In this case, it's the current year, year 3's wages being paid, so the benefit of those wages was all used up in generating daycare revenue for year 3. $23,000 will be wage expense. Here you see cash decreasing $23,000, and on the other side of the equation, we record our expense in retained earnings instead of, again, recording it in a separate temporary expense account. Remember, revenues will increase retained earnings, expenses will decrease retained earnings, and you see that has to happen here for the equation to balance. And the other thing that gets recorded in the retained earnings column will be dividends when we get to that. And the very next transaction actually is the payment of a dividend. Dividends by definition are the distribution of profits to shareholders, so it makes sense that the dividends would reduce the retained earnings account since that's where we recorded our profits. In this case, it says pay, so we know cash is also being decreased. Decrease cash and decrease retained earnings. Remember to make the notation that this is a dividend, and remember that dividends by definition are not expenses. Dividends will not reduce net income. In transaction number 5, Sample Daycare issues some additional common stock for $8,000. So again, because the problem doesn't tell us anything different, we're going to assume that that was $8,000 of cash. The no par notation here just tells us that it's okay to put all of that $8,000 into a common stock or contributed capital account. So on the left-hand side, I increased cash by $8,000, and on the right-hand side, we're going to use the common stock account to record the $8,000 increase. Again, generically, this could just be called contributed capital or invested capital. There's lots of different types of contributed capital accounts. Common stock is just one of many types of contributed capital accounts. Well, now we're to transaction 6, and this is another one of these entries that we're recording, in this case, as of August 12th. So it's August 12th, and Sample Daycare gets a check in the mail for $12,000, and it represents a 12-month contract that starts on October 1st of year 3. So we've got lots of different dates involved here. Let's, first of all, ask ourselves about cash. Was cash involved? Sure, Sample Daycare's cash just went up by $12,000, so we know we're going to record an increase to cash. Is this revenue, or is this something else? Under the accrual method of accounting, we record revenue for the goods and services provided during the current accounting period. So in this case, since it's a 12-month contract that starts on October 1st of year 3, we will provide some of these services in the current accounting period, and the rest of them will be provided in the next accounting period. There would be multiple ways to record this transaction. You'll see in the chapter notes that I want us all to do it the same way, so we'll apply a rule of thumb. Because we will not earn all of this payment received in advance before the end of the current accounting period, which would be 12/31, year 3, we're going to set the whole amount up initially as a liability on earned revenue. Then at the end of the accounting period, we'll correct this and we'll recognize the fact that yes, indeed, some of the $12,000 was earned during year 3. We'll make that correction during the adjusting entry process. So we're increasing cash by $12,000, and over here we're increasing the liability account unearned revenue by $12,000. On November 1st, Sample Daycare pays $3,600 for a 6-month lease. So it's $600 a month, and the lease is beginning right away on November 1st. Once again, we have incurred a cost. We want to ask ourselves, is it an expense? Is it an asset? It's an expense if we'll use all the benefit up before the end of the accounting period. In this case, the lease begins on November 1st. It's a 6-month lease, so it's going to run through April of year 3. So we'll use up some of the benefit of this cost, but not all of it in the current accounting period. We have a rule of thumb that covers these types of cases. Our rule of thumb is if any part of the cost will benefit the company beyond the end of the current accounting period, set the whole amount up as an asset, and we'll adjust it later. So Sample Daycare paid $3,600 for a 6-month lease. We're going to, for now, record the full $3,600 as an asset. In this case, since it's a lease, it would be prepaid rent or prepaid lease. And we know we'll have to do an adjusting entry at the end of the year to reflect the fact that some of this $3,600 was indeed used up. Let's go ahead and get that recorded. In this case, you see the decrease to cash and the increase to prepaid rent, offsetting each other on the asset side of the equation. Transaction 8, Sample Daycare purchases some office supplies. And I'm telling you parenthetically here basically to apply our usual rule of thumb. It's saying record the entire cost, at least initially here, as an asset. So they purchased $2,000 of office supplies on account. That tells us when you see on account like this, it means that it was a credit purchase. So they purchased the office supplies using credit. Cash is not involved. How would we record that? Well, we're going to record the entire cost of $2,000 as an asset, so up here, that's just short for office supplies. Cash was not involved for the first time in these transactions. The other side of the entry would be an increase to a liability account because we still have to pay for these office supplies. We owe somebody $2,000. We increase accounts payable by the $2,000. On account is very standard terminology. If you're buying something on account, you know that the account we're talking about would be accounts payable. If you're collecting something on account, you would only collect from somebody who owes you. So if you're collecting on account, we know that that's a reduction of accounts receivable. In transaction number 9, we're paying on account. If you're paying on account, you would only pay an account that you owe. So again, we're talking here about accounts payable. And you'll get used to, different phrasing with these kinds of transactions. There's very standard patterns for recording transactions, but there's an infinite number of ways to word a transaction. So the more different types of phrasing that you see and practice with, the better off you'll be. Here, Sample Daycare pays $3,000 on account. So we know cash goes down by $3,000, and we just decided that the on account means they must be paying off account payable. Or paying off part of account payable. Let's get that recorded as well. Here's my decrease to cash, and it's equalized across the equation here by a decrease to the right-hand side of the equation, a decrease to accounts payable. Okay, then finally at the end here, you see a transaction that's actually very similar to transaction number 8. Only in this case, it says that Sample Daycare is buying $8,500 worth of daycare supplies. So maybe daycare supplies are disposable diapers, food, treats for the little kids, that kind of stuff. In this case, I'm saying that we're going to do the opposite of our standard rule of thumb, and we're going to assume that Sample Daycare has their own rule of thumb for this type of expenditure. And Sample Daycare, whenever they purchase daycare supplies, instead of recording them as an asset, they record the full amount as an expense. Now, why would Sample Daycare do that? It may very well be that this type of supplies are used up pretty quickly and replenished very often. So they may choose to expense them all immediately, and then all they have to do for an adjusting entry at the end of the year is just capitalize or make an asset of whatever few amount of daycare supplies are left on the shelf. All businesses will have their own rules of thumb. They try to record original transactions in a consistent fashion because that makes it much easier for someone to record adjusting entries. In this case, we're going to record this transaction using a different rule of thumb than what I've told you we will generally use. What I would like to show you is that at the end of the day, it doesn't matter. I can correct transaction 10 with an adjusting entry the same way I can correct transaction 8 with an adjusting entry. And no matter which way management decides to have their standard rules of thumb apply to accounting transactions, we can fix it with an adjusting entry. So let's do transaction 10, and this time we're going to record the full cost as an expense. Once again, we're increasing accounts payable by $8,500. The other side of the transaction, instead of creating an asset or increasing the daycare supplies expense asset by $8,500, we've expensed the full amount here. So we have $8,500 as an expense, daycare supplies expense. The daycare supplies asset account still has a zero balance in it. The increase and decrease in this case are both on the right-hand side of the equation, but the transaction balances. We're now at the end of year 3. We could compute unadjusted balances in all of these accounts. In cash, we'd start with the $2,300 beginning balance and add or subtract all of these numbers. So if you're doing this in Excel, you may have set this up as a formula already. $5,700 is just the sum of the beginning balance, don't forget that, and all of the increases and decreases during the year. So at December 31st, Sample Daycare has a $5,700 positive balance in its cash account. And you'd reconcile that to the bank statement and make sure that that was true cash. You can see balances in our other asset accounts. The total unadjusted balances at this point is $77,100. These will be the balances, the unadjusted balances in the liability and equity accounts. They also total $77,100. Now it's the end of the accounting period, and Sample Daycare is ready to think about and complete adjusting entries.